Welcome back to another explainer. Today, we're cutting right through all that daily market noise to revisit the absolute fundamentals of stocks and shares. Look, whether you're actively fine-tuning your portfolio right now or you're just brushing up on those core market mechanics, having a crystal clear grasp of these foundations is absolutely crucial for navigating the financial landscape. So let's jump right in. Okay, let's dive into this. Here's our clear roadmap for today. We'll start with stocks versus shares, move on to how investors actually make money, cover why people choose to invest in the first place, and finally, take a realistic look at the inherent risks. Kicking things off with Section 1, Stocks versus Shares Explained. It's incredibly common to mix these two terms up, but we're going to untangle them right now. Let's start with stock. This is really just a broad, general term referring to the concept of ownership in one or more companies. When someone says, hey, I invest in stocks, they simply mean they're putting money into the overall market. They aren't necessarily specifying exactly what they own. Think of massive, recognizable players like Apple or Tesla. If you hold equity in either of those or a dozen others, well, you own stock. It's really the overarching category of the investment. Now contrast that with a share. A share is a specific measurable unit of ownership in a single specific company. So if a company decides to divide its total ownership into, say, 1 million equal parts, every single one of those individual parts is a share. Meaning if you purchase 100 shares of a specific company, you literally own a precise fractional percentage of that entire business. To put these side by side and clear up any lingering confusion, stock is the broader concept of corporate ownership. The share, on the other hand, is the specific individual piece you actually purchase on an exchange. You buy specific shares to build up a broader portfolio of stock. Make sense? Honestly, the best way to visualize this is to imagine a company as a giant pie. Every single slice of that pie is a share. By purchasing one, you're actively claiming your specific slice of that real company's total value. It really moves the whole concept away from just blinking red and green numbers on a screen and grounds it in actual fractional ownership of a living, breathing enterprise. Moving right along to Section 2, How Investors Make Money. Now that we know exactly what we're buying, let's talk about how those purchases actually translate to money in your pocket. So, the crucial point is that investors generally earn money from their shares through two distinct engines of wealth creation: capital gains and dividends. And actually, the most successful investors frequently leverage a combination of both of these to systematically build their portfolios over time. Let's break those down really quickly so they're cemented in your mind. First up, capital gains. This is your classic buy low, sell high scenario. You buy a share for $10, the company grows, it becomes more valuable, the share price jumps to $15 and you sell it, boom, that $5 profit is your capital gain. Second, we have dividends. Some companies actually choose to take a portion of their corporate profits and distribute them directly back to their shareholders on a regular basis. So you can make money by your slice of the pie growing in value or by the bakery paying you a dividend simply for holding on to the slice in the first place. All right, Section 3, Why People Choose to Invest. Now that we understand the mechanics of how it works, let's shift to the why and connect this abstract market directly to your wallet. There are basically three fundamental drivers for getting into the market. Number one, growing wealth over time. This is all about the steady, compounding growth of your assets over years and decades, the real long game. Number two, beating inflation. Look, if your capital just sits idle in a standard account, its purchasing power shrinks every single year as the cost of living goes up. Investing aims to outpace that steady depreciation. And number three, building long-term financial security. Whether you're planning for retirement or just wanting broader financial stability, investing remains a primary vehicle for securing your financial future. Which brings us to Section 4, Understanding the Inherent Risks. Let's bring the narrative back down to earth for a minute for a much-needed reality check. We need to objectively walk through these realities. First, prices can go up or down. Just as capital gains are possible, capital losses are an equal reality. A share you bought for $10 can easily drop to $5. Second, companies can perform poorly, or they can even fail completely. If the enterprise collapses, your fractional ownership essentially becomes worthless. And third, markets are constantly influenced by external forces, broad economic conditions, sudden global news events, and just the collective sentiment of other investors. All of this creates a highly dynamic and, frankly, frequently volatile environment. And this brilliantly illustrates a core warning we always have to keep in mind. Investing in stocks and shares can be rewarding, but it comes with risks. Always learn and invest wisely. Maintaining a balanced, level-headed approach is absolutely crucial here, and continuous education is hands down your best defense against those risks. Having explored all these core mechanics and realities, I want to leave you with a final, provocative question to ponder. Are you ready to beat inflation, or does the risk outweigh the reward for your specific financial future? Weigh everything you've learned today, keep asking great questions, and I'll see you in the next explainer.